All right, let's get into this. Because what I'm about to walk you through is not the kind of silver story you hear on CNBC soundbites or Twitter charts. This is bigger, slower moving, and way more strategic. And if you're only watching day-to-day silver price action, you're completely missing what's actually happening underneath the surface. In the original discussion, the framing was simple but powerful. There's a plan. Not a theory, not a rumor, but an actual policy framework that has already been set in motion, and silver just got pulled directly into it. Most people are still arguing over whether silver should be at this level or that level, wondering why it's chopping sideways or why it just crashed, without realizing that the price action they're confused by is actually part of a much larger transition phase. The key starting point is that proclamation Trump signed. This wasn't symbolic. This wasn't political theater. This was a structural move. When a president invokes national security authorities around a commodity, that commodity stops being just another tradable asset and starts being treated like infrastructure, like steel, like semiconductors, like energy. And silver just crossed that line. For decades, silver has existed in this weird limbo. It's not quite money anymore, but it's also not just an industrial metal. It sits right in the middle. That's exactly why it matters. And that's exactly why it's now being pulled into the same playbook Trump has used repeatedly. To understand why this matters, you have to zoom out and look at how Trump approaches economic power. His strategy has always rested on three pillars: tariffs as leverage, reshoring critical supply chains, and decoupling from China in areas that actually matter strategically. We've already seen this movie play out: steel, aluminum, semiconductors, rare earths. First comes the national security framing, then comes the threat of tariffs or restrictions. Then negotiations begin, and eventually, supply chains get restructured in a way that favors domestic production. Silver just became the next chapter in that same book. A minimum import price is essentially a government-imposed price floor on imported goods. In the context of silver, it means that if silver is trading globally at one price, but the US sets a higher minimum import price, foreign silver either has to come in at that higher price or face tariffs that make up the difference. The exact numbers don't matter right now. The mechanism does. Why would a president want to do this? Because it changes incentives overnight. At lower global prices, US silver producers struggle to compete with cheaper foreign supply. But introduce a price floor, and suddenly, domestic mining projects that were marginal become viable. Capital flows in. Jobs get created. Domestic supply ramps up, and the country becomes less dependent on foreign sources for a strategically important material. At the same time, foreign producers lose their pricing advantage in the US market. That's leverage. It's the same tactic Trump has used before. He doesn't always want to pull the trigger. Sometimes the threat alone is enough to force concessions. Either renegotiate trade terms, or your product becomes less competitive in the world's most important consumer market. There's also the revenue angle. If importers pay the difference as a duty, that's money flowing into the US Treasury on every ounce imported. And then there's the China angle, which is impossible to ignore. If China restricts exports or attempts to weaponize supply, a domestic price floor cushions the impact by keeping US production economically viable. This is why the proclamation matters so much. It's not about tomorrow's silver price. It's about restructuring the market over years. For decades, US policy has favored cheap imports. Corporations lobbied aggressively to keep barriers low. Consumers enjoyed lower prices. Politicians enjoyed short-term economic stability. But the long-term cost was hollowed-out domestic industries and increasing dependence on countries that don't share US strategic interests. Trump's entire economic philosophy pushes back against that model. Silver fits perfectly into this worldview, and the timing is not random. Silver has been in a supply deficit for 5 consecutive years. That's not noise. That's structural. According to industry data, the cumulative shortfall is massive. And what makes silver especially tricky is that about 70% of global silver production comes as a byproduct of mining other metals. You can't just flip a switch and produce more silver. It comes out when you mine copper, lead, zinc, and gold. That makes supply inelastic, slow to respond, vulnerable to shocks. Trump's advisors understand this. They understand that if you restrict imports while demand is rising, you create a squeeze, and that squeeze benefits domestic producers first. Now layer demand on top of that. Silver is everywhere. Military equipment, medical devices, electronics, solar, AI data centers, advanced manufacturing. The more technologically complex the economy becomes, the more silver it consumes. So you've got constrained supply, rising demand, and heavy foreign dependence. That's the exact formula policymakers use to justify aggressive intervention under national security laws. From this perspective, the proclamation wasn't reactive. It was preemptive. It was about securing domestic silver supply before geopolitical rivals can use it as leverage. Build production now, reduce dependence later, and eliminate the risk of being squeezed when it matters most. There's another layer here that doesn't get talked about enough. Governments and large financial institutions have historically been hostile to rising silver prices, not because they hate silver, but because silver acts like a mirror. When silver rises sharply, it exposes currency debasement. It makes people question the purchasing power of fiat money, and it increases the cost of producing almost everything, which feeds inflation. That's why silver has often been aggressively shorted and suppressed. But here's the contradiction that a lot of people miss. You can't simultaneously suppress silver prices and rebuild a domestic silver supply chain. Those goals are incompatible. If you want miners to invest, you need higher prices. If you want independence, you need profitability. That's why the old suppression model is breaking down. The ship has sailed. The strategic priorities have changed. This brings us to the recent crash. A lot of people panicked. Leverage unwound. Futures and options positions were liquidated. Margin calls cascaded. Algorithms fed on themselves. The catalyst was a shift in Fed expectations, a more hawkish outlook, a stronger dollar narrative, and uncertainty around Fed independence. But none of that touched the long-term thesis. In fact, you could argue that lower prices strengthen the political case for intervention. It becomes easier to say domestic producers need protection. It accelerates the timeline. It makes the argument cleaner. From that perspective, this kind of crash looks less like the end of a bull case and more like a reset within one. Now let's talk about dates, because this is where things get real. July 13th, 2026. That's the key date. That's exactly 180 days from the January 14th proclamation. That's the deadline for the Commerce Department to complete its Section 232 investigation and deliver recommendations to the president. After that date, Trump can act. Price floors, tariffs, quotas. Everything is on the table. Markets will not wait until that day. Volatility tends to increase as deadlines approach. Smart money positions early. Narrative builds. Expectations shift. Before that, there are several catalysts to watch. In February 2026, the State Department is hosting its first-ever Critical Minerals Ministerial. That matters. It signals coordination at the highest levels. It tells you this isn't just a domestic issue. It's part of a broader geopolitical strategy. In March, you've got a major FOMC meeting. Interest rates and dollar strength matter for precious metals. Every Fed meeting between now and July is a potential volatility event. Narrative can flip quickly. In late April or early May, the Silver Institute releases its annual World Silver Survey. If deficits persist, and there's every reason to believe they will, that data will feed directly into mainstream financial coverage right as the policy clock is ticking. Then there are the COMEX delivery months, March, May, July. These are when futures contracts can settle in physical metal. July is especially important because it coincides with the Commerce Department deadline. If there's stress in physical supply or if traders anticipate policy changes, it will show up in delivery data and inventory levels. All of this creates a feedback loop. Policy expectations influence positioning. Positioning influences price. Price influences political justification. When you step back and connect the dots, the picture becomes much clearer. This isn't about whether silver goes up next week. It's about the U.S. government explicitly treating silver as a strategic asset. And once that happens, the rules change. Trump's approach to silver fits perfectly into his broader economic strategy. Years of supply deficits, inelastic production, exploding demand, foreign dependence, and a powerful legal mechanism to intervene. The recent crash doesn't invalidate this. If anything, it reinforces it. Whether we get explicit price floors or just the credible threat of them being used as leverage, the direction is clear. Silver is no longer just a commodity. It's a policy tool. And that's why paying attention now matters. Not because you're trying to time a top or bottom, but because structural shifts happen quietly at first. By the time they're obvious, the opportunity is usually gone. If you enjoyed the video, like, share your thoughts in the comments, and subscribe to the YouTube channel so you don't miss out on the next important analysis update. Thanks for watching, and I'll see you in the next one.